Financial Argument. Follow us on YouTube.
And the Fed has owned these markets, and anyone paying attention knows the Fed owns these markets, whether it's real estate, commodities, stocks, you name it. The Fed has owned it. It's another reason why the Fed needs to walk very, very carefully, because if they move too quickly, everyone would go, look, aha, see what that did this.
Investors today face an unprecedented level of risks. Currency risk, major market indexes, natural deflationary forces, and endless money printing from central planners. Meanwhile, most savers today are being told to stay the course, with high commission products and risky investments dependent on fraud. There is another way forward with peace of mind investing, a financial strategy with 4 key principles: safety, income, currency risk, and finding cash-gushing value investments. Learn more about these financial strategies at fmtadvisory.com/income.
Hello, everyone, and welcome in to CrushTheStreet.com. We got an interesting discussion today, and someone we haven't had on the show for some time now, but we're going to have a discussion with a man who's been spot on in his analysis on a number of things. He first came on the show to share his thoughts on the Dow to gold ratio, and that we will see it go back to a historical average, and we are seeing just that play out. And also, he was on to discuss oil with us, and oil was around $30 a barrel, and he was one of the only people out there at the time saying that it was unlikely for oil to go into the low 20s and into the teens, and in fact he said it would go up, likely go up in spring and into the summer. And here we are on my screen right now. I'm looking at $50 oil. So a lot of insight here. His name is Nicholas Green. He's a financial advisor for fmtadvisory.com. And I have to tell you that every one of my listeners that have gone to him for financial direction have nothing but amazing things to say about their experiences with him. So I couldn't ask for a better person to be on this show today. Nicholas Green, thanks for joining me.
Kenneth, thank you so much for having me on your show. It's a pleasure to be here and Crush the Street, and I like what you're doing, so keep up the good work, and thank you so much for the kind compliments. I appreciate it.
Nicholas, we have a rate hike right around the corner, and I want to just get your thoughts here before we talk about a few other things. But what can we expect as the economy continues to falter under tremendous amount of distress regarding the interest rates and the Fed here in 2016?
Well, I think the narrative is I think there are some expectations that they may raise rates, they may not. No one really knows for sure. But my base case, if you recall the last time we discussed in our interview, is with Trump gaining so much momentum and the Fed being anti-Trump because Trump is anti-Fed. They want Trump would like the Fed audited. Trump would like to see an interest rate change. He'd like to see yell and go, and all these different narratives that Trump would like to see happen. Well, so, Trump is becoming sort of like kryptonite to the Federal Reserve and to the Democratic Party, which the Fed is pretty much a Democratic made-up body. So the Fed, I said in January, will keep policies relatively easy, at least going into the election, just because they want to support the financial markets. They want to try to support the economy as much as possible. And we saw what happened when they raised interest rates by a scant 25 basis points in December. Things just completely fell off the wheel. China was blowing out treasuries. We had the reverse the QE happening, and you just have massive liquidity coming out of the markets, which caused huge air pockets. And the Fed backed off immediately as Trump started to gain all that momentum, and it kept policy easy. So even the recent jobs report, which was pretty disastrous, you almost wonder if that's just another narrative that the Fed wants to throw out there right now to be like, look, the job market's a little soft right now. This is why we can't raise interest rates in here. We want to support the economy. We want to support the job market. Because the economy is just, it's just inching along, crawling along as it is, and that's what, near 0% interest rates. And so you start raising interest rates in here, China comes back to play, the stock market gets more volatile. Those are not good things for Hillary Clinton, the Democratic Party, come the election. And so I think that will keep things relatively easy, personally. But that's not what I base my decisions on, but that's just something that I've been sort of sticking to, and I believe that that will keep policy relatively easy going into the elections.
Yeah, well, we are seeing that, and I'm reading this headline right now on investing.com, and it says, now the rate hike likely in September. You know, this is the top,
right.
Kicking this can down the road. So, Nicholas,
at least to those elections, right?
Yeah, at least to the election, right? You know, one of the things that you've been talking about here is stagflation. And this is a problem because what basically stagflation is we'll have high rates of inflation with very slow economic growth. And most notably, the last time we saw official stagflation was in the 1970s. So kind of give us an idea of what you are forecasting here in regards to stagflation.
Well, sure. So I think we're already starting to see signs of stagflation, which is an economy that's not moving much. It's barely crawling along at best. In fact, you're seeing a lot of bad earnings reports, especially from discretionary consumer companies. And so you know, Disney just reported a month or so ago and wasn't good. And so you're seeing some signs of stagflation already, which is an economy that's not moving much, is cinching along, but you're starting to see rising prices across the board. And you know, this is really relatively well known, but you know, the rental inflation since 2009 has skyrocketed. It's been annualized at 5 or 6% at this point since 2009. So you have rental inflation that's skyrocketing. You have health insurance premiums that are skyrocketing, and you're starting to see prices inch up in other areas. And so when you look at the core price index, the Fed looked at and their mandated 2% price inflation, well, they're now right up about 2% price inflation. They're right about their mandate right now, and yet here they have a 0% interest rate policy merely, and we're talking about barely even above interest rates a quarter basis point because of the over-indebted situation. So there's too much debt, which is causing a slow economy, but you've got all these easy policies fighting these forces. And so the deflationary forces are the real economy. The inflationary forces are the easy monetary policies, and prices starting to go up across the board. And so these are the worst case scenarios. And if you look at the 70s, inflation went from 2% to 12% in like a 2-year period. And there's a point where inflation is really, really, really bad for the economy, but it's really, really, really good for people who are properly positioned for it. And so I think today more than ever, people need to have some of their assets allocated toward areas that can help them for the probability of higher elevated inflation in the next few years. I'm not saying it's going to happen in the next 6 months or 5 years, but I don't believe the Fed can ever really raise rates too quickly without completely destroying government finances. There's been virtually no political will to change our present course with our national policy. You know, we're running huge cash deficits and unfunded deficits for our structural entitlement programs, and there's been virtually no changes to that whatsoever. And so the Fed has to, I think, continue to try to help inflate those debts away, the present value of those debt obligations away. And I don't think there's much of an option for them, which is another reason why, you know, Trump gets in there. It's time to be a little more cautious in some areas. But yeah, stagflation is one of the worst possible scenarios you can look at. But on the other hand, if you're an investor and you have assets, it can be potentially one of the best possible ways to increase your net worth. And so it's nothing to be worried about, but stagflation is happening. I think we're starting to see signs of it right now.
You know, one of the things you brought up was rental prices going up, and it just reminded me of the unintended consequences of government and all the economic stimulus that we've seen as a result of the 2008 crisis, the response to the collapse that we saw in 2008. We saw asset prices go up, we saw stocks go up, we saw home prices go up, and you know, I'm hearing and reading reports now that people can't afford to buy single family residence, and so it's creating this demand demand for more renters, and the prices in that area is going up. And again, it's, the unintended consequences of reckless monetary policy, and there's always a consequence. There's always an equal and opposite reaction when the government tries to manipulate the free market. So, Nicholas, transitioning over just a bit here, one of the characteristics of stagflation of the 1970s was high oil prices. And, I read that oil peaked in the 70s, in inflation-adjusted dollars at $107 per barrel. So, you had some very excellent analysis on oil earlier this year. So I want to kind of get your thoughts on how oil will relate to where you see the economy headed here throughout the remainder of the year, and just kind of, going forward.
Sure. Well, to back up a second, what you were saying about the Fed and the unintended consequences is absolutely true. A lot of unintended consequences, but I've said this for a long time. The Fed has owned these markets, and anyone paying attention knows the Fed owns these markets, whether it's real estate, commodities, stocks, you name it. The Fed has owned it, and it's another reason why the Fed needs to walk very, very carefully, because if they move too quickly, everyone would go, look, aha, see, the Fed did this. And so Greenspan's famous for saying, back in the tech bubble and all of those large cap bubbles in the early 2000s. I think it was even the 1998 when he actually said it, the irrational exuberance. But what the Fed has actually done is created almost a rational exuberance among investors. If you have a 0% interest rate policy, over time, after 7 years of having 0% interest rate policy, it's natural for money to start to move to areas where it's looking for yield. And so that's what money's been doing for 7 years. It's been looking for yield. It's much better to earn 3% on a company dividend that's increasing over time at, say, 12 or 13 times earnings than it is to own 1.5%, 2% 10-year treasury that's not going to grow and is going to have a negative carry compared to where inflation is today. So that's a rational move for our investors. But you've gotten to a point where you have now these relatively high valuations across the board. Even when you look at being an owner or an investor in real estate now, while every market is different, you're seeing general pockets of overvaluation in real estate. You're seeing pockets of overvaluation in, say, like the utility sector. The utility sector is selling at nearly 2 times book, almost 100% over its historical valuation, is because people see utilities as a safe, with as an orphan play to get higher way to earn income and dividends. But that's no longer safe just based on the valuation. So what the Fed's done, it created rational exuberance at some point where money has moved to areas, but that's the unintended consequence where you have all this money going to real estate, you have investors going to real estate, because there was a much higher yield or cap rate that you get in real estate than you can get, say, earning money in short-term bonds or safe treasuries or that type of area. And so what that's created is, right, a really huge rental market where people that got pushed out of their homes now can't buy homes because they have bad credit, and on top of it, now they're paying much higher rental rates. And so these are all things that the Fed can't control. They can try to suppress the price of gold. They can try to massage the numbers, but the reality on the ground is much different than the narrative. And so,
one thing I would say is it really goes to show how America is turning into more of a third world country, where the rich are getting richer because they own assets, and the poor are getting poorer because they own less assets, and the prices of things are getting more expensive on them. So
and truly the middle class is shrinking. I mean, this is one of the first times in 100 years where you're seeing a middle class that is actually shrinking. And a lot of this is Federal Reserve-driven policies. And so this is where the Fed has put itself. The Fed is sort of in a box. And I believe that, in some ways, at the same time, it creates a lot of opportunity. So unintended consequences and the Fed-driven markets that have created in some ways, some rational exuberance, but how it will play out once you get to these valuation levels that are pretty high across the board in a lot of areas, with the exception of we talked about the gold Dow to gold ratio in one of our early interviews, and people just love that. And what that really wasn't about the Dow necessarily or gold, as you recall. It was more about real assets, and real assets have gotten cheap. And it's not just about gold, but oil was cheap. Other commodities have gotten cheap, and some other real assets, like especially the chemicals area today, is particularly cheap. But anyways, that was what that was about. And so you have these pockets of undervaluation in the real asset space, but you have high valuations in financial assets and even real estate today. So that was the interesting thing about that Dow to gold ratio. And we're still there today, where I believe that some of those areas are still the most undervalued pockets in the market today. And going to your segue about what we talked about when oil was at 30, we talked about the Dow being overvalued compared to gold, the miners being cheap relative to gold. The overarching theme that I think your listeners need to listen to help protect themselves is, look, if you're going to be an investor, you want to invest in the cheapest parts of the market with the best management teams running the best businesses in those sectors with the best assets. And if you do that, you can't help but go right over time. If you're finding the beaten up sectors, if you look at the mining sector, one of the most beat up sectors over the last few years, it's been one of the leading sectors, right? The gold miners have been skyrocketing. If you look at oil, it got completely beat up on a 2% change in marginal production over usage. And it went from 106 a barrel down to 27, right? It got completely beat up on a very small change in demand supply. Very small change. And so this is one of the most necessary resources in the world. So when everyone's crying wolf or running for the streets, those are areas where you want to be looking at. And it doesn't matter what area it is, but you want to buy cheap. When you buy cheap, those will dictate your future returns. And that's the problem with the market today. And it doesn't matter what the Fed does. You have an 18 times multiple on the S&P 500. And going back to the stagflation theory, there's a point where inflation is not good for multiples, because what happens is you get margin compression. And you have margin compression, you have an earnings hit. You have an earnings hit, you have multiples come down. And so if you look at the last 100 years, what's really interesting on an inflation rate, the peak multiple, once you hit above 2%, the 2 to 3% range, maybe all the way up to 4%. The peak multiple is about 20 times on the S&P. Once you get to those inflation rates, that's the peak. Today we're already at 18 times, and the core CPI is around 2%. Once you go above 4% historically, it's very, very bad for traditional financial assets like the S&P 500, which is just your common companies. Once you go over that, the multiple tends to compress, and it can compress fast and quickly. It did it, for example, in the 70s. Between 73 and 74, the market dropped about 50% when the inflation rate went over 4%. But it took the inflation rate going over a certain threshold before the market and the earnings just couldn't handle it. And so those are things to be really, really stay nimble for in these markets today, for sure.
So, Nicholas, let's get your thoughts here on oil with where we are today. And I'm just curious, because we did see that stagflation and oil really spike back in the 70s. And I know you do a lot of research here on oil. So what are your thoughts here on oil 2016?
I believe that oil is still undervalued at $50 a barrel. I mean, with the marginal production, the expensive oil that comes out of the shale, tight rock, all the oil that comes out of those areas, you really need, for that marginal production to come back online and increase, you really need oil above $70 a barrel. And so oil is still undervalued around $50 a barrel. It could have a pullback like any market, and after a rise from 27 to 50, it can see a short-term pullback before it starts to head higher again. But there's going to be an undersupply of oil if oil stays under $70 a barrel going into. I'll even make a date on it. By the first quarter of 2017, there'll actually be an undersupply of oil if oil doesn't keep heading higher, because that's all the data that I've looked at and all the research I've done indicates that that's where we're heading. As soft as the economies are around the world, oil demand never goes down. I mean, oil demand just goes up over time, and that's all it's been doing. It's oil demand's been going up, and so when you see the amount of oil production that has come offline and the amount of barrels being produced coming down as they have, there's a sort of a crossroads that will meet before the first quarter of 2017. Well, there'll literally be an undersupply of oil. There won't be enough oil being produced and what's being consumed. There's still some reserves out there that will help, but should that happen and oil stays at 50 and we're still at $50 a barrel in the first quarter of 2017, all of a sudden by the next summer, this time, right, we'll see $140 a barrel, because that's what the markets will need to do to make sure that there's enough production coming online to supply the world and satiate the world's demands. And so not much has changed with my original analysis. And the other thing is, as you recall, one of my base cases why oil wasn't going down to 10, it wasn't going down to 20, is the Fed, the governments around the world would do anything they needed to do to keep oil from going down to $10 or $20 a barrel. That would be a very, very scary world. But one of the big reasons why is because the banks have a lot of oil and energy debt on their balance sheets, and they were hemorrhaging, and it was starting to show up in a big way across the board through the big banking sector. Companies like Wells Fargo were announcing massive write-downs on their energy exposure, and so we know one thing that the despots want to sort of kind of conceal as much as possible is they don't want to have big banking problems surface again, and oil and energy staying that low for that long would certainly cause banking problems again. And so my thesis was, if the market didn't do it, the Fed would do it for the market. Something was going to move oil higher, but anyways, oil is still undervalued at $50 an oil. I believe it's still heading, well north of $70 a barrel within the next 6 to 9 months.
Yeah. Well, in an economy that isn't really growing and struggling, higher gasoline prices at the pump is not going to be good. And that, again, goes and supports your stagflation theory that we've been talking about here. So, Nicholas, I want to kind of get your closing thoughts here and just, your overall all-arching advice. I mean, just kind of reiterate what you said on how investors can thrive in this new economy.
Well, I'm a big believer in valuations and buying cheap, but I think beyond just buying cheap, I really believe that you have to connect your money to the right people, and that's something that I have always believed. And I'll just give it a specific example, but you can buy a great business, but if it's run by the wrong people, you're not going to make money over time. And so let's just do a simple equation. This is something people overlook all the time, but you can't just buy cheap. You got to buy great assets with the greatest people running those assets. And they're very few and far between. So you're not going to own 20, 30, 40, 50, 125 businesses that are great and run by great people. You're going to be very selective, and you have to be very selective. But let's say you have a company selling at $10 per share. There's 100 shares outstanding altogether, and the company earns $10. Right? So you have $10 divided by 100. You have $1 earnings per share. You have a 10 times multiple. Well, let's say this management team owns none of the stock themselves, and they have no skin in the game, but they want to get paid more, right? Mm-hmm. And this happens constantly in publicly traded markets. Even privately it can happen. So the management teams decide, look, we need to increase the size of the business, and so to do that, we need more personnel, and we need higher salaries. And so they come out with, say, a stock option dilution of 20%, right? But now you just increase your shares from 100 to 120 shares, but you still have $10 in earnings. So you just got your earnings per share just got diluted by 20%. Mm. And why does that happen? It's because management wasn't really aligned with you. They get paid more, doesn't matter what happens to the earnings. The earnings can go from $10 to $8 per share. Now you've even been diluted more. But it doesn't matter. The management will get paid more money. And so you really need to look for the right people running the right businesses and beating up assets. And one of the companies that I've been big on, like, for example, in the mining sector is one of the best examples. Seabridge Gold is a fantastic gold company run by Rudy Frank. He keeps 90% of his own net worth in Seabridge Gold, 90% of his entire net worth. He's produced over 2,000% return since 2000, one of the few miners that still have a nice return in the year 2000, even with all the ups and downs. But even better, you can see how well he managed the money for all stakeholders, not just shareholders, but also bondholders and preferred equity holders. They have the lowest enterprise value per share per ounce of gold in the ground of any large, major, noteworthy gold company in the world. And so they've created 2 ounces of proven gold in the ground for every 1 share that they've ever diluted. And hence the reason why they've had sustainable long-term earnings. It's still cheap today, and the point is, though, is when you have a guy like a Rudy Frank, when you have a guy like Martin Franklin, another good example is a Berkshire Hathaway. Warren Buffett kept over, I think, over 95% of his net worth his entire life in Berkshire Hathaway stock, a single company, right? Mm-hmm. This is alignment of interest. And so anytime you're investing your money, you want to make sure your money is being connected to the right people and the right assets at the right prices. And it takes an extreme amount of work to get all those 3 things, right people, the right assets at the right prices, and then to run a portfolio that way. So it takes a lot of time, and that's what people should be looking for. And if they don't have the time, they should be looking for outside help that can help in those areas. Mm. So that's the big thing for me as a money manager to sort of share with your listeners and viewers is just make sure you're connecting your money to the right people who are true fiduciaries of your capital, and that includes management and board members that should be fiduciaries, but oftentimes they're just not laying in their own pocket. So you need to be very shrewd. You need to be very careful on where you're putting your money, what assets, and what managers are running those assets. And that's the number one thing that I would look for today. And then you got to buy cheap. You can't buy overvalued assets because you won't make any money for a very long time.
Well, hey, you're a rock star, Nicholas. I mean, I couldn't have said it better myself. Everyone, if you want to reach out to Nicholas Green, he's with fmtadvisory.com. We'll have the contact information at the bottom or side of the video. Nicholas, again, thanks for coming on the show with me today.
Thank you so much for having me, Dennis. I look forward to the next time.